Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And obviously yesterday, very volatile day in the markets. So let's take a look and see what our outlook is, or what the result of yesterday's sell-off has been, and what our outlook is for going forward. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll take a look at the major equity indices and where they sit. Yesterday, obviously, a significant sell-off in the grand scheme of the current market conditions, but fairly small in terms of the bigger picture. So we'll take a look at that. We'll take a look at where bonds currently sit, where commodities sit, and what the sector rotation model is currently showing us in terms of the subsectors. And then we'll look at stocks that are on the move for both on the bullish side as well as on the bearish side of things. So when we look at the S&P 500, if you look at the longer term chart, as you can see, this long-term uptrend is still very much intact. So yesterday, about a 2% drop in the equity markets. It was still a fairly small drop in the grand scheme of things, but it did puncture the 50-day exponential moving average that has held pretty much throughout the entire uptrend. But yesterday we broke below that level. Now, right now we're about to reopen this morning above this 436, 435 level, which was the previous low that we had in mid-August. So the fact that we're back above that level certainly leads me to believe that this support level or support zone so far is still holding, and we're likely to see a bounce here today, especially after what has been a very high volume day yesterday, one of the highest volume days we've seen in quite some time. So the fact that we've seen this strong down volume day and the fact that we're about to open up above that level leads me to believe that we're likely to see a bounce. Now, once we get towards this gap level around 441 or so, that's where we'll have to see where markets go. If it gets rejected at that level and starts to move lower, then we can see further downside. But if it gets back above that level, then I would say that we would very much resume the longer term bullish trend that we have seen here in the broader equity markets. The NASDAQ 100 was a little stronger. It held the lows here from August yesterday at the session lows and bounced all the way back up towards the opening price around 365 or so. We're opening up around 368 today, back above the 50-day moving average. So again, same price action that we're looking for, potential bounce back towards the gap, and then we'll see how the markets react to that gap level, whether it gets rejected and starts trading further lower, or gets back above that level. That'll help us dictate the longer term view here in the broader markets. And then when we look at small caps, while was weak yesterday, held up fairly well. It still is inside of this range. It's been in this range for 9 months. Not much has changed here for small caps. It is opening up higher here today. I would watch the 221 level here. That's the gap level here for the small caps. If we get back above that level, then we could see a resumption back to the 232 all-time highs. Otherwise, further downside here right now. And then if you look at RSP, the equal weight S&P 500 index, so far it's still holding this support level around 146 or so. It's kind of right now in no man's land, but same thing, high volume day yesterday. Expectation is that it'll trade back up to that 153 level, which was the highs from back in May 5th. If we get back up that level, we'll have to see how the markets react to those levels. And if it starts to sell off, again, more neutral tone. If we break back above that level, more bullish tone here for the broader markets. But the one thing I do want to show you is that the number of stocks trading above its 50-day moving average is currently at 32%. So more than 2/3 of the market are currently trading below the 50-day moving average. So this is at a fairly extreme level. As you can see, these are levels that we haven't seen since September of last year or during the pandemic sell-off here. So this is something that is severely oversold, and that's part of our view that you're going to see some type of short-term bounce here, at least in the short run over the next couple of days. We still have the Evergrande default that we'll likely see, how that's going to play out here over the next couple of days. That's going to add some volatility, further volatility to the markets. We have the Fed interest rates this week or the Fed meeting that is potentially can cause some volatility in interest rates and subsequently the equity markets, as well as the debt ceiling. These are all things that are on the radar here for this week. But the one thing I will say is that, the concerns that Evergrande will be, the China's Lehman moment, I don't necessarily think that will be the case. I think that central banks and the government have learned quite a bit from the Lehman defaults, and have already stepped into the broader markets, financial markets, to soften that blow or potentially bail out Evergrande. But regardless, I don't think we're going to see the same type of collapse that we have seen here in the U.S. Financial markets with the Lehman default as we would with Evergrande. So I do think that those risks are a little overblown. And then if we look at bonds really did not move that much yesterday. We did see a move higher here, but still very much within the range that it's been trading in, which is around 152 and 146 or so. It is starting to test the upper bound of that range. If we start to see a breakout here, that would be the continuation pattern is complete after this rally. Once it's complete, this would target pretty high up there around the 160 level. Now, this is obviously going to be at risk of the Fed meeting this week. If they start talking about bond tapering, we're likely to see bonds trade lower here. If they commit to further bond purchases, that's when we can see potentially that breakout. So this was more likely going to be news driven as to which way it breaks out, one way or the other. And then when we look at the dollar index again has failed to break out above this $93 level twice now. Failed once in April and twice again here recently in August and September. So this is causing, gold to so far stay here around this 164 level here. We have a bit of a inverted head and shoulders pattern starting to form here, if you want to call it that. But we really have this neckline at 172. It's got to get back above 172 in order for gold to really start reversing higher. So far, I don't see that. You still have this major gap fill to fill here, and then it could potentially still move lower. And then if you look at the long-term chart of gold, clearly in a downtrend. So far, I don't see any evidence of that downtrend shifting direction anytime soon. Crude did manage to break back above this downtrend here. So far, trading more sideways rather than higher here, but momentum has shifted a little bit higher here. So my expectation is that you could see crude trade back to that 74, potentially $76 level, especially as supply is still looking a little weak here at the moment for some of the Gulf producers here in the U.S. So when we look at the sector rotation model, this is really where we see some rotation. Yesterday's sell-off did shift things a little bit here for some sectors. At the moment, you really only have two sectors that are leading: energy and discretionary. Everything else is either weakening, lagging, or just only staples is currently still in this improving state at the moment. And there are some interesting staples names that we'll take a look at here today. But as you can see, technology really hasn't moved at all in the past week or so, but we have seen both communications and real estate come down significantly in terms of momentum, and both momentum and relative strength. We also saw utilities, industrials, materials lose quite a bit of ground here. And then we see financials and healthcare starting to improve and getting into the improving part. Not quite there. Financials looking fairly strong. Healthcare took a little bit of a turn here yesterday, so we're not quite sure if we're going to see that leadership out of healthcare, but certainly financials at the moment look strong. Staples looks like it's constructive. Discretionary and energy so far look fairly strong, while the other sectors are still weakening. And technology very well could, over the next couple of days, start strengthening again. And we'll take a look at some of the names here in the technology sector and what our views here for those names are. So looking at the sectors, Some of the ones that I want to point us to is, are some of the ones that really started to collapse here yesterday, like industrials. We saw a big gap lower here in industrials and a gap lower below some major support levels here around this $99 level. This was a major support level that has held pretty much since much earlier in the year in March or so. And since we've made a broke out above that level, notice how we've been trading lower highs here, and we finally broke below this level. So this is one that I'm watching because my expectation is that we're going to bounce, get back to this gap fill level, and we'll see how the market reacts. And potentially what we could see is more of a rejection at those levels and for industrials and materials to continue lower. That's what we're currently watching for. If it can get back above these gap fill levels and resume that uptrend, that would be constructive. But if it gets rejected here at those levels, both industrials and materials, two of the weakest sectors at the moment, may see some further downside. On the flip side, communications did hold these major support levels that has held for quite some time around the $81 level. Looks like it'll bounce higher back towards the $84 level here, which is you do have some minor resistance. You have the gap fill level, you have 84 level. Those are, again, levels to watch. See how the market reacts to those levels. If it gets rejected, then we might be looking at what looks like a bit of a head and shoulders top here that could be a further downside. But if we get back above 84, that would be extremely bullish, in my opinion, for communications, which again remains on a very strong uptrend here at the moment. And even despite yesterday's sell-off, does not break that uptrend. And we see the same thing here for consumer discretionary. Consumer discretionary continues to make higher highs and higher lows despite yesterday's sell-off. So this is one that's probably the most bullish out of all of these sectors here at the moment. Clear uptrend here on the long-term chart. Short-term chart continues to show all the right patterns here for further upside here. If we break out above 186 or so, 180, just 185.5, that's when we can see a continuation upside continuation for consumer discretionary. So let's take a look at some of the names that are currently in this market. And I think that after yesterday's day, it's easy to start looking for bearish opportunities, but I actually think there are far more bullish opportunities in this market at the moment with yesterday's sell-off. This is really where we try to be a bit contrarian sometimes when it comes to these major sell-off days, especially when we see major sell-off days on such high volume. And the price action yesterday, I actually think was quite constructive in terms of how strong the markets came back towards the last 30 minutes of trading. And overnight, we saw some strength here. We did see European and Asian markets trade lower here, but so far, equity futures here in the U.S. are still holding up. And specifically, if you look at the price action of many stocks yesterday, many of them closed near their opening price. Many of them, even though they traded lower intraday, managed to climb back up towards their opening price. And you have a lot of sectors, or rather subsectors, that remain incredibly strong here in the moment. So for example, semiconductors, one of those sectors. Broadcom has been in this consolidation pattern for about 9 months almost. It entered this pattern here back in, let's just call it beginning of 2021. It's been trading sideways since then. And what you have is the all-time high around 495 when it put in back in February. It tested it multiple times, finally broke out above that level a few weeks ago. And so far, this 495 level has been holding as support. And even yesterday's sell-off has still held this as support. And this is the opportunity that I see to the upside here for some of the semi-names, strong semi-names like Broadcom. You see a similar price action here in Texas Instruments. You have a big move here to the upside. You have a sideways continuation pattern, and you have a double top here at 197.5. Now, this is one that has not broken out yet, but despite yesterday's sell-off here, as you can see from the candle, pretty much closed at the same price that it pretty much opened yesterday, despite having a very volatile day, showing me that there's strength here in a name like this. This is likely to retest that 197.5, and if we break out above that level, there is further upside here for Texas Instruments. You see a lot of strong setups here in semis, and semis has been outperforming the market. And then you have names like Texas Instruments and Broadcom that are outperforming the semi space. The other place that you also see a lot of strength here these days at the moment is really in the travel stocks, specifically the reopening stocks. You have Expedia Group, which had a very strong run off the pandemic lows from the $40 range here or so all the way up to the $190 range. And we've seen a big pullback here over the past few months as the Delta variant has surged on. But we're finally starting to see some what looks like a bit of a bottoming formation. It's managed to break back above this 151, 152 level, which was a gap fill level. It's filled that gap. It's broken above that level. It's broken above the 21-day moving average, broken above the 50-day moving average. And we have seen some, what looks like some momentum starting to turn positive on the short run. And this is the opportunity that I see. It's a bit of an early opportunity, but this is one that I start to see play out here in yesterday's weakness. One of the few sectors and sub-industries that were up on the day yesterday on what was a very volatile and incredibly difficult day for most equities, but we've seen a lot of travel stocks perform well. You see another reopening stock, Darden Restaurants. Darden Restaurants holding up incredibly well here over the past few months. It has lost some momentum here since the surge of the Delta variant, but unlike other reopening stocks that have pulled back, Darden Restaurants was trading sideways. So the relative performance of this stock to the reopening stocks has been incredibly strong, and it's just shy of breaking out from its all-time highs. It continues to make higher lows, higher highs, and this is really one that I think has the opportunity for further upside for, especially when you look at the weakness that we've seen here in the market yesterday. Darden Restaurants had a pretty strong day, actually closed up substantially higher than where it opened yesterday. And then we look at also some of the consumer staple stocks, finding some defense right now in this volatility. Procter & Gamble continues to make higher highs, higher lows, and just continues to hold this major 147, 141, 142 level here or so. This is one that I think has some further upside here back towards the 147.5 all-time highs for a strong stock in a strong sector here at the moment. And then on the flip side, when we look at the technology names, this is really where we see some weakness in yesterday's price action. Now, IBM has not been performing well since the June highs. Relatively speaking, it's been underperforming the major markets and its sector. But over the past couple of months, it's been battling this 137 support level here or so. This was the gap level that it had on earnings. It gapped up above 137, and then over the past couple of months, have really struggled to hold this level. And just over the past couple of days, started to break below these levels around 137, and that is the opportunity that I think has some further downside here for a name like IBM. Now, we very well might see a bounce back towards this 137, and that could be a better entry point for this. So this is one that I would be cautious of in terms of chasing. My preference is to be patient, look for a bit of a pullback, wait for a bit of a bounce here, as we expect the markets will likely bounce here over the next couple of days or so. As you see that bounce or as you see that rally, those are opportunities to potentially enter a short position on some of these stocks that have seen some downside. And when you look at some of these tech stocks, we have some steep uptrends that are starting to get broken here. Facebook is in that particular category. Facebook has had a very incredible run since March. This is a $250 stock that's almost a $400 stock in just a few months. So this is a stock that has outperformed not only the market, it has outperformed the tech sector, and this is one that perhaps is seeing a little bit of some weakness here right now. We've broken the trend line here on Friday. We've broken the 50-day moving average here yesterday. Just like all the technology stocks, my expectation is that you're likely going to see a bounce higher here, but that bounce higher here could be an opportunity for some downside. And if we look at this, you have some congestion here around 350. A bounce higher here would probably target 350 here at the first target, but I would really watch for a break below 350, because if you break below 350, you're headed back towards around 330. 240 or so, and then below that is 300. Those are some major targets here to the downside if we do see some further weakness from a name like Facebook, which is not only has some risk here because it's outperformed the market by so much, but also because of some regulatory concerns that we may start to see here from names like Facebook. Another one that I think is worth paying attention to is also Apple. Apple's recent court case is not particularly favorable for Apple in the long run here, especially since the valuations that we've seen on this company is largely tied to their services business and their app store business, which is, strong reoccurring revenue as opposed to a hardware business. But, as we can see here, it tried to build a base above its all-time highs prior to that, which was around 144 or so. It tried to build that base and it tried to rally, but on bad news, the stock came back down. It's now below this level here. So I unfortunately cannot help but think that there's some further downside here for Apple since it failed to break out higher here, that false break, and we're now back below the 145, 144 all-time highs prior to the past couple of months. And then if you look at stocks like UPS, some of the industrial names, this is also industrials, one of the weakest sectors here right now. UPS failing to break out higher here really has seen quite a bit of weakness here over the past couple of quarters, and it's back below the level that it was trading above. This is the same setup that we saw in IBM. It gapped higher on earnings, came back to test this level multiple times as support, and now we're starting to see a break lower here. This is going to target 180, the gap level here to the downside. That would be my primary targets. And if we see a break below 180, then that could head back down to the 168 level. And this really comes down to the competition that it starts to have with Amazon right now in terms of Amazon shipping most of its own products, and now it's potentially starting to ship other retailers' products here as well. So, both UPS and FedEx under pressure here at the moment from those outlooks. So with that covers what I wanted to share with you here today. Like I said, a lot of volatility here in the markets here right now. Yesterday's volatility, while scary, just keep in mind in the grand scheme of things, it's not a huge move here. And as a result of that volatility, we do actually have more opportunities. So take advantage of that and seek some opportunities here in this market over the next couple of days. With that, thank you so much. I hope you guys have a great trading day.